Hello everyone, welcome to EduTap. So in today's session, we are going to discuss two very important news articles of finance. Okay, so the first one is about the RBI that has announced the scale-based regulatory framework for the non-banking financial companies. See, a discussion paper was issued for the public comments on January 22, 2021. Okay, and in this, based on the inputs received from the public comments, it was decided that there is a need for the revised regulatory framework for NBFCs. And the discussion paper was about the scale based regulatory framework only. So this, we will discuss all the important things, that what is the framework, what were the regulatory changes that was in the scale based regulatory framework. Okay, so we will discuss all about the framework. In the second news article, this is also very important because SEBI, the Securities and Exchange Board of India, has declared the government owned firm PEC as not fit and proper. Why is it so important? Because it is the first time that SEBI has gone against the first that has given the announcement, or it has announced that government owned firm is not fit and proper to run. Okay, so we will be discussing these two important news articles. Before starting with the news articles, please subscribe to our YouTube channel and join our Telegram channel for the PDF of this session. And you can get the link of the Telegram channel in the description box below. So now starting with the news article, that is the RBI has announced the scale-based regulatory framework. See, the scale-based regulatory framework is a four-layered scale-based. Okay, that is the NBFCs are divided into four different layers, and the four layers are decided as per the size of the NBFC, as per the activity the NBFC is doing, as per the perceived riskiness, the riskiness the SBFC has in the in the financial market. Okay, and this scale-based regulatory approach has come why? To regulate the non-banking financial companies, to regulate the NBFCs. This will be effective. This scale-based regulatory framework will be effective from 1 October 2022. Okay, so now before going forward in the news article, let's understand what are NBFCs, because this whole news article is about NBFCs only. So NBFCs are the entities that provide bank-like functions and bank-like services as well as the other financial services, but they do not have a banking license. So under what are they regulated or registered? So they are registered under the Companies Act of 1956, and they are regulated under the RBI, by the RBI, under the RBI Act, under the framework of the RBI Act of 1934. Okay, so this is how it get registered, and this is how it is regulated. So NBFCs are the non-banking financial companies that have so many functions in the financial market of our country, in the primary market, in the secondary market of our country. What services do they provide? They provide loans. There are loan companies, there are asset management companies that take care of the assets of the people that want to invest but do not have much knowledge about the financial markets. So the asset management companies take care of the assets of those people. There are housing finance company, infrastructure finance company, mortgage guarantee company. So many different financial services are provided by the NBFCs. Okay, so now I hope you have understood the base of the NBFCs, that they are not regulated under the banking. They do not have the banking license, but they are regulated by the RBI. Now there are some NBFCs that are not regulated by the RBI, because like venture capital fund company, okay, or we can say the merchant banking company, they are under direct control of the SEBI, that is Securities and Exchange Board of India. We can say the insurance companies under NBFC, they are under the IRDA, that is the Insurance Regulatory and Development Authority. Okay, so this is also important because the news article is about NBFCs. So this is the whole of NBFC. How are NBFCs different from bank? Because they do not accept the demand deposits, because like demand deposits is like I am saving 1,000 rupees in the bank, tomorrow I need 500, so I take out that 500 from the bank account. So in NBFCs that cannot happen. If you are submitting your money, if you are depositing your money, you have to keep it for the set time period. Okay, so NBFC cannot accept the demand deposits, and they cannot issue the check also. There are close to 10,000 NBFCs. The entire NBFC sector is about 25% of the assets of the banking industry. So you can understand that how big NBFCs are in the financial market, in the financial market, in the primary market and secondary market. So they hold a very big ground in the financial system of our country. Okay, this all information that you are retaining is from the newspapers only. So this becomes important because the newspapers have given you so much information that you have to retain for the exam also. So now you will ask that why was there a sudden need of the revision of the regulatory framework? Okay, so what was happening that there was a company ILNFS, if you have heard, that is the infrastructure leasing and financial services. So what happened with this company that it defaulted in its debt obligation. Okay, it couldn't pay back its debt, and that led to a liquidity crunch, a liquidity crisis we can say, in the financial services market, okay, as well as there was a company Sri Group. It also defaulted, and that led to a very big problem in the financial market. There was a Diwan housing finance company. This also defaulted. So many big NBFCs were defaulting. They were creating problem in the market. That was creating problem in the financial market. Okay, so RBI thought that we need a better regulatory framework so that, because they are so big in the financial market, that it directly affects the market of our country. Okay, that directly affects the financial system of our country. So RBI thought that we need a better framework so that such kind of things, such kind of risky things doesn't happen in the market, because this affects the small investors or the big investors also. So this was why the RBI thought of bringing the regulatory framework. So now getting back to the whole news, see, this is the framework that is given by the RBI. We will come back to it. Okay, we will understand it through the next slides. Okay, so in the framework there is a base layer, that is the lowest layer, then there is a middle layer, then upper layer and the top layer. See, in the top layer it is said that it will be ideally kept empty. Okay, and as the riskiness increase, as the asset size increase, the layer also increase. That's why there are more regulation for the top layers compared to the lower layers. Okay, so the base layer have the non-deposit taking NBFCs, and they have the asset worth up to 1000 crore, and these are the name of the NBFCs like peer-to-peer, the account aggregator, the non-operative financial holding company, as well as the entities that do not avail the public funds, as well as the customer that do not have the customer interface. So these are the NBFCs that are in the base layer. Okay, that non-deposit taking NBFCs that have the asset less than 1000 crore. Okay, the deposit taking NBFCs, it is less than. So the deposit taking NBFCs irrespective of the asset size. So if you are taking deposit, if the NBFC is taking deposit, then it will be under the middle layer. And the non-deposit taking firms that have asset worth rupees 1000 crore or more. Okay, so in the middle layer, non-deposit will also come, but they should have at least 1000 crore or more than 1000 crore. And these are the name of the the NBFCs that comes under the middle layer, that is standalone primary dealers, the infrastructure debt fund, the core investment company. Remember the ILNFS, it was a big core investment company and it was regulated by RBI under the RBI Act. Okay, so housing finance firm, the Diwan was a housing finance firm. The infrastructure finance companies will also come under this category, so they will come under the middle layer. Then the upper layer, the top 10 eligible NBFCs that will be chosen by the RBI according to some criteria. They will come in terms of their asset size, they will reside in the upper layer and irrespective of any other factor, and they will be chosen by the RBI. Okay. Then the top layer, it is ideally expected to remain empty. This layer can get populated, means there can be some NBFCs that come under this layer when RBI thinks that there is a substantial increase in the potential systemic risk of some specific NBFCs in the upper layer. Then they will transfer those NBFCs into the top layer. If they think that some of the 10 eligible NBFCs are becoming risky, are having some risky ideas or are becoming risky for the financial market, for the financial system, then they will convert those upper layer NBFCs into the top layer where the regulations will be harder for them. So I hope you have understood it all. Still, we will see it through the notification of the RBI so that you understand that I have told you everything about the framework. So it shall comprise of 4 layers, as I told you, the bottom layer, the lowest layer is the base layer, then the middle layer, upper layer, and then comes the top layer. Okay, then in the base layer, as I told you, non-deposit taking NBFCs asset size 1000 crore. Below the asset size of rupees 1000 crore. NBFCs undertaking the following activities, as I told you. Then the middle layer, all deposit taking NBFCs as well as non-deposit taking NBFCs with asset size 1000 or more than 1000 crores. Then NBFCs taking the following activities. Then comes the upper layer, that is in this layer, the upper layer shall comprise of NBFCs identified by the Reserve Bank of India, as I told you, and there are enhanced regulatory requirement based on set parameters. As I told you, they will be going through some higher parameters and scoring methodology that will be decided by the RBI only, and the top 10 eligible NBFCs according to their asset size will be kept in the upper layer. Top layer, as I told you, will be ideally remain empty, and the layer can get populated if the RBI is of the opinion that there is a substantial increase in the potential systemic risk in this NBFCs that are in the upper layer, and they will be transferred to the top layer. Okay, see, this is very important and you have to remember it. So that's why I'm telling you so much about it and telling you again and again about it, so that you have that set framework, that what is the framework and what NBFCs come under what system, what layer. Okay, this is the regulatory changes under the scale based. We understood the framework. Okay, now we will understand that what are the regulatory changes under the scale based regulation. So the regulatory minimum net owned fund, see, before there was 2 to 5 crore of the net owned fund that they had to keep minimum. Okay, and this now it has been changed to 10 crore. And what are the names of the NBFCs for which this criteria has been changed? That is the NBFC ICC. Remember it, there are only 3 names. So ICC, the Investment and Credit Company. So NBFC ICC. Then comes the NBFC MFI. Okay, that is the microfinance institutions. Then comes the NBFC factors. So for these 3 NBFCs, the criteria has been changed of the minimum net owned fund from 2 to 5 crores to 10 crores now. And the 10 crore criteria, the increase of the criteria will be applicable from the March 2027. Okay, and these are the 3 names of the NBFCs, the ICC, that is Investment and Credit Company, the Microfinance Institution, and the NBFC Factoring Companies. Now, from March 2027, these 3 NBFCs will have to keep at least 10 crore. So when it comes to the experience of the board, the next regulatory change is that at least one of the board members should have relevant experience in the bank or NBFC. Okay, so that you have more professional experience of managing the affairs of the NBFC. So now this has become an important thing, that at least one of the directors of the board should have the relevant experience. The next one is that there will be a ceiling of 1 crore for each borrower. For each borrower, there will be a ceiling of 1 crore when a IPO, that is initial public offering, is released. That is, see, Paytm currently got the approval of SEBI that it can present its IPO it can do the initial public offering in the financial market. So what is it? That it will be putting its share for the first time in the market, where everyone, where all the investors, every retail investors and all can buy the shares. So that is the initial public offering, that you are offering your share in the public in the domain, in the market. So in the initial public offering, what happens that the big institutions usually take too much borrowing from the NBFCs and they buy too many shares, so that the other small investors do not have much time to buy the shares. So for that, it has been said the ceiling will be of 1 crore, that one borrower cannot have more than 1 crore from any NBFCs, and the ceiling will come into effect from the April 1, 2022. And NBFCs, if they want, they can have more conservative limits. One last is left, that is under the new framework the RBI has said that the non-performing assets. I have told you so many times about the non-performing assets and it's a very important term. Okay, I will put a link in the description box also where I have told you the NPA about the NPA, or there is some news about the NPA. So see, NPAs are the assets that, like, you have given a loan. Sorry, the bank or the NBFC has given the loan, but the interest is not coming, or even the principal amount is not seen anywhere for at least more than 90 days. So RBI has said that if the NPA, if there is the asset that is not coming back, if the money is not coming back for at least 90 days or more than 90 days, then that will be a NPA for the NBFCs. Right now, what do NBFCs do? That they keep the criteria of 150, like more than 150 days. That if the asset is not coming back, if the loan is not, if any amount is not coming back for 150 days, then also they do not categorize it in NPA. Okay, they categorize it after 180 days or 150 to 180 days. So now the RBI has said that if it doesn't come from like more than 50 days, then by 2024, that by 2024 what you have to do, that if the asset is not coming back, if the money is not, if any, not even interest, not even principal is not coming back for more than 150 days, you have to consider is the NPA, and you have to show it in your balance sheet that it is a NPA. And if it is not coming back by 2020, like if till 2025, what you have to do, that if it is not, if the money is not coming back for 120 days, the borrower has not given you any interest payment, have not given you any interest payment, any principal, then if it is more than 120 days, then you have to consider it a NPA. And by March 31st 2026, if the borrower has not given you any interest or any principal for more than 90 days, you will consider it a NPA, that is non-performing asset, and you have to show it in your balance sheet. Okay, so this framework is created by RBI for the NBFCs. So now we can understand this, the top 10 eligible NBFCs in terms of what will always reside in the upper layer. So net owned funds, potential systemic risk, or the engagement the NBFC has in the market, or the asset size. So as I told you that it is according to the asset size, irrespective of any other factor, that the top eligible NBFCs will reside in the upper layer. Okay. So such kind of questions can come. The framework is very important. Any question from the framework will come, that NBFC, this ICC, that by what time, or like 2 to 5 crore they have currently, so how much it can grow, they have to keep the minimum net owned funds of what. So you will say that it has been changed to 10 crore, and the date you have to remember also. So now going forward to the next news, that is the SEBI has declared the government-owned firm PC as not fit and proper. So why is it, and why is it so important? So SEBI, it is the first time that SEBI has declared any of the government-owned company to not be fit and proper. Okay, and PC Limited is a 100% government-owned company, and the reason of SEBI deciding that it is not fit and proper is that the PC Limited acted as a broker and carried out illegal trades on the National Spot Exchange Limited. On the National Spot Exchange Limited. So illegal trades, like the SEBI consider the paired contracts in the NSEL as illegal. So the PC became the broker and it carried out illegal trades, and that's why the SEBI is considering the PC to not be fit and proper, and the trade was carried out in between 2010 to 2013. So now in October 2018, what happened, the Bombay High Court said, according to the regulation 7 in schedule 2, if you want to consider any entity as not being fit and proper entity, then the board or the SEBI is entitled to not only conduct the inquiry against the applicant intermediary, against the PC as a whole, but it can also conduct the inquiry on the principal officer, the director, promoter, and the key management persons. That not only the entity will be blamed, the entity as a whole will be not considered not fit and proper, but also the people involved, the higher level of the people. So the PEC board that is managed by the secretary level officials from the Ministry of Commerce, now it requires the permission. The PEC requires the permission from the ministry to conduct the business. So now they will also be questioned. It is thought so. Okay, so the SEBI can also inquire them, conduct an inquiry against them. Okay, and now why is the Ministry of Commerce involved? Because PEC is under the Ministry of Commerce and Industry. Okay, it was formed in April 1971, and PC is the Project and Equipment Corporation of India. Okay, and see, it was a subsidiary. It was a subsidiary of the State Trading Corp of India Limited. Corp of India Limited. So State Trading Corporation of India Limited, and in 1991 it became an independent entity. The PC became an independent entity in the 1991 under the Ministry of Commerce and Industry. Okay, so it required the permission from the ministry to conduct its business. So now the question arises that SEBI will be conducting its inquiry among the officials also, for the officials also, because according to the Bombay High Court statement, it is not only the entity but also the people that will be involved and that will be inquired upon. So the PC has failed to conduct its business according to the standards which are expected to be maintained by registered securities market intermediaries. So PC is registered under the securities market, and there were some norms that it had to follow, that it had to not trade. It will be illegal to trade in the paired contracts, of the NSCL, that is National Spot Exchange Limited, but it still became the broker and conducted trade in that. So now the the PEC is said to be not fit and proper. So we discussed two very important news articles today. The first one was about the RBI that has announced the scale-based regulatory framework, and the second news article was about SEBI that has cancelled the registration of the PEC Limited, that is a government owned company. Okay, and why? Because allegedly it allowed its client to deal in the illegal paired contracts. What are the paired contracts? See, paired contracts refers to the buying and selling of a contract, of a commodity, through two different contracts and at two different prices. So paired contracts refers to the buying and selling of a same commodity through two different contracts and at two different prices. So thank you very much. I hope you have understood the whole concept of the scale based regulatory framework, as well as the PEC Limited, why the SEBI cancelled its registration. Thank you very much. If you have any query, you can mail us here.